Hey everyone, this is Adam Bergman, founder and CEO of IRA Financial. Welcome to another episode of AdBits, where I will be sharing bits of knowledge about self-directed retirement. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, and welcome to another episode of AdBits. I'm Adam Bergman, tax attorney and founder of IRA Financial. And on today's AdBits, we are going to be talking about borrowing from your IRA. Can you do it? Well, hope I got your attention because you can't. But there are a couple legal ways that you can get access to your IRA funds, either tax-free or potentially even penalty-free if you're under 59 and a half. So you cannot borrow anything from your IRA like you can if you have a 401k plan. So if you really want to borrow up to 50K or 50% of your account value, whatever's less, and you're self-employed or you have access to an employer 401k plan, then you probably want to check out the 401k plan loan option because you will be able to borrow tax-free up to 50K or 50% of your account value, whatever's less, and use that for any purpose. 5-year loan, payable at least quarterly, at a stated interest rate of at least 3.25%, which is what the prime is as per the Wall Street Journal as of May 2021. Now, what happens if you have an IRA? That's all you got, right? You don't have access to an employer 401k. You're not self-employed. What do? Well, you got a couple options. Number one, if you're over 59 and a half, you can pull the money out anytime you want in a pre-tax IRA and just pay tax. Okay, and if it's in a Roth, then so long as you're over 59 and a half and the Roth has been open at least 5 years, then you can pull the money out tax-free. But what happens if you're under 59 and a half? You have a pre-tax IRA, you're under 59 and a half, or even you have a Roth IRA and you're under 59 and a half. What are your options if you need money? So the first is a indirect 60-day rollover. Once every 12 months, you can pull money out of your IRA or Roth IRA for 60 days and use it for any purpose, anything. But if you pull cash out, you must put cash back. If you pull property out, like stock or cryptos or real estate, you must put like-kind property back. It's within 60 days. You need to make sure you're mailing that check within that 60-day period. The IRS is very strict about policing the 60-day rule, so you must be careful. So the 60-day rule is per IRAs in the aggregate. So if you have 12 IRAs, you can only do it once for all your IRAs every 12 months. There's actually another 12-month period for 401ks, but if you're talking IRAs, even if you have 4 IRAs or 6 or 8 IRAs, you can only do it once every 12 months. And it's 60 days, you got to put the money back. So just be careful about that. What happens if that doesn't work out for you? What are some of your other options? Well, disability, God forbid, total and permanent disability. You can pull the money out before 59 and a half, pay tax, but no 10% penalty. Education, qualified higher education expenses. You can do it in a IRA, not a 401k, but you can take a hardship distribution in an IRA, pay tax, but no 10% penalty. And again, the things I'm mentioning now are the items. Those are taking a distribution, paying tax, but no 10% penalty. If you want to pull the money out without tax and 10% penalty, that 60-day loan, technically loan, I should say, it's a indirect rollover once every 12 months, or that is the best you're going to do. But you're limited to the 60 days and you got to return all the money. Whatever you don't return is subject to tax, 10% penalty if you're under 59 and a half. So getting use of those funds, tax-free, penalty-free, under 59 and a half, other than that 60-day rollover, is pretty much not going to happen. So we talked education. Right now I'm talking hardship distributions where you can prove a hardship and get access to the funds without paying the 10% early distribution penalty, but still paying tax. qualify higher education expenses. You can do something called a 72T election or a series of substantially equal periodic payments. That you can do. It's an election in IRA 401ks where you can elect 5 years or 59.5, and you have to pull out a set amount until you reach 59.5 or at least 5 years. So if you're 57, you got to go to 62, or if you're 51, you can go all the way to 59.5, and you need to take that set amount out every year. So let's say, and it's a formula you can check out on the IRS website, but let's say the set amount is $4,000 a year for that 5-year period, and you need 20. You can't do it. You got to stay to that formula. So that's called series of substantially equal periodic payments, and that is available for IRAs and 401ks. Home buyer exception. Qualified first-time home buyer exception up to $10,000, available for IRAs, not 401ks. Hardship, pay tax on the money, no 10% penalty. If you have an IRS levy, also, you can use that money without paying the 10% penalty. Same with medical. Amount of unreimbursed medical expenses, as long as it's greater than 10% of your adjusted gross income. You can use it for IRAs and 401ks. Pay tax, no 10% penalty. Health insurance premiums paid while unemployed, available for IRAs, not 401ks. Tax, no 10% penalty. If you're in the military, certain distributions to qualified military reservists. If you're called to active duty, available in IRAs and 401ks, you can pay the tax, no 10% penalty. So that's essentially it, okay? There's something called the age 55, which is separation for services. Generally applies to 401ks, where you can pull the money out, subject to tax, no 10% penalty. So just to summarize, you cannot borrow from your IRA. You can with a 401k. So if you're listening or watching this and you have some self-employment income, doesn't have to be full-time. It could be a matter of, hey, I sell baseball cards on eBay, or I give swimming lessons, or I do some consulting. Then you could set up your own 401k for your business. Could be a sole proprietor, single member LLC, corporation, C or S, partnership, whatever it is. As long as you have some income, doesn't even have to be a lot or even profitable, just some business income, and you have no full-time employees other than yourself, another partner, or spouses of the partners, and a non-owner employee, someone who works over 1,000 hours. So if you hire 1099s or someone works in your business for 300 hours a year, they are not considered employees, and you can then have a solo 401k for your business. That will allow you to borrow the $50,000 or 50% of your account value, whatever's less. Use that for any purpose. So that's the best way of getting tax-free, penalty-free use of your funds. If you're not self-employed or don't have access to a 401k plan at work, then you got to deal with IRA rules. Your next best thing is a 60-day indirect rollover once every 12 months for all your IRAs. The other options are the hardship distributions I mentioned. And that's probably the best you're going to do. Unfortunately, there's no tax-free loan available to an IRA, whether it's a SEP, simple, Roth, or like. So there you go. I hope you've learned something. I hope I encourage you to think about ways to save, but also if you need to get money out of your IRA, there are efficient ways of doing it. Be educated, avail yourself, learn about the potential opportunities under the hardship distribution rules, whether it's for medical, education. You can do substantially equal payments under 72T. You can also do first-time home buyer up to $10,000. So there are some really interesting ways, God forbid if you need it, or on a positive note, like buying a first-time home buyer. If you satisfy that requirement, you could use those funds and then not pay the penalty, but still pay the tax. So you can't get around that tax. You can circumvent the 10% penalty. If you're over 59.5, again, you can always pull the money out anytime you want, just pay tax. If you're over 59.5 and you have a Roth and the Roth has been opened at least 5 years, then you can pull those funds out tax-free. So unfortunately, can't borrow money from your IRA, but there are some creative ways you can tap into it without potentially paying tax in some cases for 60 or so days, and then ultimately without paying early distribution penalty, but still paying tax. So hope you enjoyed today's AdBits. I did. Learned a lot. I love going through some of these IRS rules. There's some discrepancies, believe it or not, between IRA and 401k hardship distributions. Not sure why. Should pretty much apply across the board to all retirement accounts, but they don't, like the first-time home buyer. So that's always, I don't want to say exciting, but it's always good to refresh myself on these rules because they are important. And hopefully now you have them so you could share them with your friends, colleagues. So make sure that everyone is educated as best as they can on the retirement rules, and you could be as efficient as possible when you have to take money out of your IRA. So thanks again for listening. Thanks for subscribing. If you haven't subscribed, please do. Spotify, Apple, SoundCloud. You can also check us out on YouTube. Subscribe to IRA Financial channel. We drop 5 videos, sometimes more, and 3 podcasts, AdBits, AdMail, and Adam Talks, generally on Tuesday, Wednesdays, and Thursdays. So great way to catch up on tax, investment, retirement, self-directed topics. I just did a couple podcasts on Adam Talks on estate taxes with Biden, capital gain tax proposals Biden, and a new John Doe summons that was sent to a crypto exchange and what that means for crypto investors. So it's a lot of cool stuff that obviously pops up all the time when it involves taxation, retirements, investments, and especially alternative assets. So my job is to keep you guys informed how you can best educate yourselves and be the best retirement investor you can be. So take care, be well, stay safe, and talk to everyone again next week.